Hello, and welcome to this special session in which we will present and discuss the top findings of BNamericas 2023 Infrastructure Survey for Latin America, which was carried out with support from Deloitte. My name is Laura Superno. I'm the Managing Editor for Research at BNamericas. Today, we'll spend a few minutes looking at the results of the survey on key questions for the industry, and then we'll have a one-on-one discussion with Camilo Salomon, Chairman and CEO of Global Impact Assets, a global diversified financial services organization focused on fostering sustainable prosperity by financing high-impact infrastructure projects. We'll cover topics including trends in public spending, financing, and political uncertainty in Latin America. The full results of BNamericas survey can be found on our platform in the report Infrastructure Survey 2023, Rising Optimism Despite Political Risks. Now taking a look at the survey results. The 2023 Infrastructure Survey showed the best optimism in at least 6 years regarding public infrastructure budgets in Latin America. 44% say there will be a slight increase in budgets over the next 12 months, while another 18% foresee a significant increase, and 17% more think public budgets will remain steady. Adding together the 44% and 18% who think budgets will increase slightly or significantly, we can see that more than 60% of all respondents believe budgets will grow to some degree, and this is the largest showing of optimism about public infrastructure budgets in Latin America since we began asking this question back in 2017. The graph illustrates a trend of ever more stagnant public infrastructure budgets in the years just prior to the pandemic. And then in 2020 and in the immediate recovery period following the pandemic, faith in public spending grew, but so did the perception that public spending could weaken, which reflects that strain on public coffers during that time and the dilemmas that authorities faced in allocating resources. Now, in 2023, many countries in the region have experienced GDP recovery and are perhaps better positioned to invest in infrastructure. Survey respondents view Brazil as the best positioned country to do this over the next 12 months. The country has strongly emphasized infrastructure programs in the wake of the pandemic, and the return of President Luiz Inácio Lula da Silva in 2023 has also been viewed by many as favorable for public spending. Chile, on the other hand, has been struggling with inflation, low GDP growth, and a slowdown in the infrastructure program since President Gabriel Boric took office in 2022. At the same time, Brazil is also seen by far as having the best opportunities for private infrastructure investment. Another noteworthy aspect visible in this chart is the downward trend in Chile and in Colombia compared with 2 years ago. Again, as the agenda has slowed down under Boric in Chile, and also with the arrival of President Gustavo Petro in Colombia in 2022. Although Petro has made efforts to push ahead with tenders, he is a more left-leaning figure and, like Boric, has placed greater emphasis on socio-environmental evaluation of projects, which has been a factor in slowing them down. Opinions about Peru have moved in the opposite direction, though, with somewhat more stability now in the country in the political sphere, and institutions such as Proinversión taking a more aggressive approach to advancing projects and tenders. And just to emphasize how favorably Brazil has been viewed across our 2023 survey, the country also received the most responses as having the best overall investment climate for infrastructure in the region. The upward trend in opinions about Brazil, seen here, is closely in line with the chart we saw earlier, showing the growing faith in Brazil's public infrastructure spending. Chile is in second place here as having the best investment climate, although with a decline in responses in line with the last two charts also. The rest of the countries in the region received less than 10% of responses. When it comes to financing and market conditions, a strong majority of survey respondents expect to see continued impact from inflation on their activities during the next year, although more people expect a moderate or a small impact compared to the effects of inflation that they experienced over the past 12 months. The issue of inflation is reflected in a modest improvement in expectations regarding financing conditions in the year ahead. Compared to our 2022 survey, more respondents in 2023 believe that financing conditions will improve, and fewer believe that financing conditions will worsen. We also asked participants which type of financing they view as the most attractive, and most believe that either multilateral and development banks or project finance is the best choice. And lastly, the 2023 infrastructure survey returned a dramatic result in terms of what participants see as the biggest threat to the sector in Latin America over the coming year. Political or country risk jumped to 64% of responses from just 8% of responses a year earlier, while concerns about government finances, GDP, access to capital, and inflation all subsided significantly. And with that, we'll now move into our discussion and analysis of the survey results. Hello, Camilo Salomon, Chairman and CEO of Global Impact Assets. Welcome, and thank you so much for joining us.
Thank you, Laura. It's a pleasure, and thank you for having me.
Camilo, we saw that in the 2023 survey, there was strong optimism around public funding for infrastructure projects in Latin America. What is your own observation now and going into 2024 regarding government spending on infrastructure in the region?
Yes, and our view on this aspect is that historically, government funding has been one of the hindering factors for the development of infrastructure, especially in emerging markets, where the countries don't have the capacity to finance or guarantee the financing of these large infrastructure assets with recourse to their fiscal budgets. So having a positive trend right now is good, but the cyclicity of the political administrations in emerging markets is always much shorter than the investment horizon that large infrastructure projects require. So this is a discrete situation that we shouldn't rely on. Our view in our approach to financing infrastructure in emerging markets is to release government entities from the responsibility of financing or guaranteeing the financing of these projects, taking recourse on the fiscal budgets, and transfer these to the international capital markets.
Okay, perfect. So considering that, what is your view specifically of public-private partnerships, that mechanism, in terms of its role in Latin America now and in the near future?
The PPP legal framework, it has positioned itself for the last 10 or 15 years as the right way to go. It puts all the stakeholders of a project in the place they are best prepared to perform for the benefit of the project. So if you take the funding or the financing responsibility away from the host government entities and give them the responsibility to focus on creating a good venue, to create the conditions to enable institutional investors and private investors coming in to put their money to work in the project with an acceptable risk profile. That's the perfect role for the host government entity. And then you transfer the responsibilities of funding, financing, risk management, operations and management to companies that are better prepared to do that. So the PPP legal framework has proven to be the most effective way to develop infrastructure in emerging markets.
Sure. Just a follow-up on that. In some countries, it's obviously more developed than in others. What would you say about applying PPPs then in countries where it's less developed? What's lacking in the countries in order to be able to go forward?
Yes, I agree that there have been countries that have understood the convenience of the PPP structure faster than others. That's quite a process. It takes a political willingness to change the public contracting regulation in the country, and that could be a 3, 4, 5 year process if you have to go to Congress and submit a bill and make it a law to change the public contracting regulations. But there are fast tracks. You can see how, if the project is ruled by terms and regulations provided by the World Bank instead of the local regulation, we can still, execute the PPP model while it is being implemented in the local public contracting regulation, and that, enables the projects to be done faster. The project adopts this methodology. The countries adopt this methodology.
Okay, perfect. And speaking of the World Bank, the next question we were going to talk about was the outlook on financing. In the survey, people chose multilateral banks or development banks as the top, or the biggest percentage of people thought that was the best source of funding. And also project finance, has emerged over the last years and become maybe just as important. In your view, is there one best type of financing for projects in this region? And what local trends or even global trends do you see influencing this over the next year or two?
Yes, I totally agree on the project finance approach because it's a very asset methodology to vet the cash flow generation capacity of a future asset. And that's the healthiest way to make an investment or financing decision. The cash flow has to be enough to provide for guarantees, to serve the debt, and to give a return on the equity. If it doesn't pass muster on these three elements, the project cannot be structured as a stand-alone transaction, which means that the capital provider will only take recourse on the future cash flow of the asset and the project's assets. No external collateral like a government guarantee or government subsidy or a tax abatement or collateral from a holding company or a sister company, which has nothing to do with the economic merit of the project. So that's how bad projects get funded. But if you go strict on the project finance approach, only good projects get funded. So I totally agree with the project finance approach. As it relates to the multilaterals, with all due respect, I think they're slow, they are inefficient, and expensive. Getting money from these multilateral institutions could be as expensive cost of capital as going to the commercial markets. And the collaterals required by the multilaterals are no different than the commercial lenders. So I really don't see the advantage of going through the multilaterals. Our approach would be to go directly to the capital markets with a proper risk management structure. If you go to any of these multilaterals, only to get the eligibility of a project could be 18 months.
Okay.
If you go to the commercial insurance market to provide risk management, then you go to the debt market directly with an adequate risk profile, you can get better cost of capital than what the project gets from the multilaterals in a totally different time frame.
Your response is very interesting, and especially if we take into account that perhaps multilateral development banks, in a sense, have a role to play in financing projects, whether or not it's more attractive than a commercial bank for the country or the entity trying to fund it is one thing, but they will fund it.
But let's not forget that the main role of the multilaterals is not to provide financing, is to take risk. To take the risk that would be expensive to transfer to commercial lenders. That's the main role of the multilateral. So if you combine, yes, of course, it's great to have the seal of a multilateral to credit worthiness to a potential borrower, of course, But as I said, that is a long process. So our perfect combination would be to source capital from the capital markets and bring the multilateral to take that risk that the commercial insurance market is not willing or able to take. So that's called the topping of the risk. So if you transfer risk first to the insurance market, and they will never take 100% of the risk, insurance companies also are, they also want to see somebody lose money before they start losing money. That's called the deductible in an insurance policy, and it's called equity in project finance. So there's always a gap of 10, 20, 30% that is not transferable to the insurance market. That is where the multilateral can take a very important role to do the topping on whatever portion of the risk of the project was not able to be transferred to the commercial insurance markets.
Okay. It's interesting. And, considering all of that, I'd like to ask you about your own work and the focus of your work, which is often directed to impact investing. So I'd like to make sure we all understand how this approach differs from traditional infrastructure investment or traditional investment decisions, and what are the main barriers, but mainly the opportunities, for you with this specific approach that you see in the region.
Yes, and the impact component in infrastructure is of paramount importance. First, it creates involvement of the communities, and that by itself becomes a factor to mitigate risk. If you see that the community is going to benefit from the development of an infrastructure asset, and you have what is called the community license, because there are factors in the project that are earmarked to enhance quality of life, just not provide transportation or energy or telecommunications, but also to improve quality of life of the community in the jurisdiction of the project. That's a very important risk mitigation factor. And the other one is that it creates value. It does create a lot of value to the investor. There's already a lot of metrics and financial analysis methodologies that prove that every dollar that you put into social and environmental impact, regardless of the asset class of infrastructure, it contributes to increase in $8 the enterprise value of the asset. So doing good is also good business. So I see that's the angle of impact. And of course, infrastructure is always very large size of tickets, of financing. So it's a lot of money. There's a lot of financial resources that can, depending if you do things right or wrong, you can create a significant positive impact or a significant negative impact. So that's one of the key differentiators of the infrastructure as an asset class to create social and environmental impact. I think that by now it's clear in the capital markets that institutional investors have understood the value and the need to put the impact component in their investment strategies. As a matter of fact, we know that the largest pools of capital from institutional investors have been migrated to impact investment strategies. So they got it right already, where I think there's a lot of work to be done. Funny enough, is on the sponsor side, and the owners of the projects. They still don't get it that by doing things with this significant impact component, the projects are going to have more value and are going to have a better risk mitigation. So that's the obstacle, and as you say, that's where the opportunity is.
Interesting, very interesting. You know, speaking of risks and mitigating them, we also saw in the survey results that nearly 2/3 of respondents now see political risks in the broad sense as the most important threat for the sector in Latin America. Other risks, inflation and financing, people are less worried about, perhaps, compared to political risk. You know, how do you evaluate that result, and how do you think the sector needs to approach uncertainty in the region in the near term?
I totally agree with the survey. You know, the most feared risk by institutional investors aiming to deploy assets into emerging markets is the political risk. And I will delve deeper into what is political risk. The three main components are local currency evaluation risk, local currency convertibility risk, and rule of law risk, the legal stability of the contracts risks. That's the most feared risk by institutional investors. If they go to any country and put their money to work and they sign contracts, they have this huge uncertainty that the contracts are going to be honored, because all these awarding of contracts is driven by politics. So by definition, if there's a change of administration in a country that has a contract ongoing across the change of government, the first thing the new administration does is revoke all the contracts that the previous administration has done. And that's what brings the political risk to levels that are not acceptable to institutional investors. So if I were to focus on how to manage risk to create a good environment for institutional investors is work with all these host government entities to get all these legal frameworks and contracts into a level of risk that is acceptable to institutional investors.
Hmm. Sounds like good advice. Maybe easier said than done, but that's the direction that the sector needs to take. Well, that's all the time we have for today, Camilo. I thank you very much, and to Global Impact Assets for being part of the discussion. Thank you also to everyone watching. I'd like to remind our subscribers that they can read the complete report with the results of the survey on our platform. And for those of you who are not yet BNamericas subscribers, I do invite you to visit BNamericas.com, where you can find a variety of data, news, reports on infrastructure and other sectors in Latin America. Thanks very much again, and have a great day.